Hello, this is the SOFTRAX audio blog for the week of October 15th, 2018. My name is Graham Hulme, and I'm the Vice President of Product Management at SOFTRAX. This week's blog will circle back to a topic covered in our audio blog the week of September 24th, 2018. And notably, the theme of that blog was Trust but Verify. And specifically, a central point of that week's entry was that while ASC 606 aims to advance the comparability and reliability of companies' revenue results, a potential gap still exists in terms of companies disclosing, more information on their processes and controls and practices that lead to their financial results, so that the end users and consumers of those financial results can qualify the numbers effectively. And so, while companies are on the hook to have internal controls audited and tested, a typical reader of financial statements likely doesn't have the time or the capability to dig back through companies' prior documents and filings to validate this, these processes, controls, procedures, etc., in terms of how these were validated by them and then by their auditors. And so as a result, a topic that we put forward was that adding a baseline disclosure requirement in companies' filings that explains in detail what a company's contract and order to cash and contract order to revenue processes entail, it will help the readers and users of those financials grade the validity and the potential risks of the reported results with a much finer eye. And so this week's blog aims to support that point with quantitative information based on some notable articles that touched on this topic over the past few weeks. And so to start, there was an article in the Wall Street Journal titled "Companies Are Finding More Accounting Flubs." And it was an article from September that makes the following key points based on work done by a research firm named Audit Analytics. And so, the point is that the number of material accounting mistakes made by U.S. public companies declined every year since 2006, but preliminary data for this year indicate a reversal. During the first 6 months of 2018, 65 companies detected accounting mistakes significant enough to require them to restate and refile their entire financial filings to regulators, compared with 60 companies for the same period last year, according to Audit Analytics. And so, notably the uptick this year, it does coincide with the advent of ASC 606, the new tax laws and the new leasing standards taking effect. But I think, with that point in mind, I think the question comes, how do companies get into these situations, factoring in that each is going through internal and external audits that theoretically should catch these issues? And so I think to that end, a good article that I noted during the past week was by an author named Tiffany Couch from a firm called Acuity Forensics. And it was published on CFO.com, titled Auditing the Auditor. And it puts forward, a variety of reasons why these situations can play out at companies. And really, I think some of the fundamental points that the author makes, start with, auditors are nice. And so, auditors have a mindset that, comes from a viewpoint that they're following the rules, they have a high ethical standard. And so that worldview and that view of, themselves can shape how they're viewing the actions and results from the companies and parties at the companies that they're auditing. And so if something's off during an audit activity, that mindset can lead them to make an assessment that it's an honest error when it may not be. So that's the first point. I think a second point is that the author makes is really that the nature of an audit isn't designed to find fraud. And so I quote, "During an audit, auditors look at the financial statements of a company and calculate materiality. Materiality is the calculated threshold by which, if information is withheld or misrepresented in financial statements, it would impact the decisions of stakeholders that rely on those documents to make economic decisions," end quote. And so due to that approach, the focus is on transactions that are or above the materiality line. So it's conceivable that areas of error, honest or otherwise, in the case of fraud, could occur below the line and simply not be detected. And so that segues into a third point the author makes, which is, a sample during an audit does not tell the whole story. And so, when an auditor gathers samples of representative transactions to verify whether these were processed correctly and according to internal controls, it's just that, it's a sample. Now, obviously they're doing, the best job possible, but it becomes a matter of math at that point. How many examples can you cover that really would give you a viable opportunity to catch, errors or fraud? Now, certainly, the higher percentage of samples you take, the higher percentage, you could potentially cover with respect to, transactions that would have had errors or fraud. But in a typical scenario, the number of samples is limited, therefore the percentage is low that an auditor would have eyes on to potentially identify such issues. So, that point in terms of a sample does not tell the whole story makes sense. I think that the next two points the author makes are really, fraudsters are clever, and fraud typically or often looks like a simple error. And so when you combine those 2 points, I think it's really, it's not obviously, earth-shattering, but it is, both represent solid points to the extent that if someone's going to the extent of purposely making errors or putting forward inaccurate numbers, they certainly will be clever about it, and they certainly will do so in a way that masks it so that if it's identified, not only would it look like a simple error, but it could be explained away as such. And so if it blends in with what would be considered honest human or system errors, then you've got to an extent a smokescreen that becomes very difficult for an auditor to get to in light of the factors we've talked about so far. And so I think it leads to the final point, which is really auditors are constrained by time and budget, which is a practical reality. There's a time box and a budget box that goes around an audit, and an auditor can only go through so many transactions within so much time according to the budget that they're afforded. And so, when you take all these key points that the author makes and you marry them with quantitative information from audit analytics, you can see, how situations like this play out at companies where restatements come up and there's a lack of internal controls, processes, procedures around revenue recognition and revenue management, but also it could be across the board in their financial results. So I think, compounding, what we've talked about, the SEC is considering a plan to widen the availability of the exemption from the requirement that an outside auditor attests to the soundness of a company's financial reporting controls. And so that really potentially opens the door wider to errors and fraud on companies' financial results. And if you think about it, it's really an interesting point in time for that idea to come forward by the SEC in terms of, in light of the points made earlier, which are, you've got new guidance related to revenue for 606, the new lease standard, new tax laws, and rules. So I think, and that's just naming a few, but those are fundamentals that are changing. Consequently, this type of idea at a point in time when complexity is rising, certainly is questionable. And so what was interesting is that, that thought didn't obviously just cross my mind. It crossed others well before mine. And one of those individuals was actually part of the SEC. And so an SEC commissioner, and I quote, they made the following statement: "I look forward to their recommendations," and he is referring to the SEC committee that's looking at, expanding the exemptions. I hope it comes with some real analysis and with some real proof. But if all it is giving away or giving something away to people who have been asking for a while, I am not likely to support it, end quote. And so, it's an interesting topic that seems to have different viewpoints even within the SEC itself. So, trying to come full circle with where we started today, we talked about a Wall Street Journal article. And within that article, there was a quote from Michael Burke, who's a partner at an accounting firm named UHY LLP. And it resonated for a variety of reasons, but it's been a theme throughout our audio blogs over the past couple weeks. And I quote, "Errors can be anything from a misapplication of accounting principles to an error in inputs in accounting software or an error in Excel schedules," and end quote. And I think, we've talked about this before, but regardless of whether an error is an honest mistake or something that goes to the other end of the spectrum in terms of fraud, it has negative impacts on the company and on the team members that should have caught that mistake. And in many cases, it leads to material, results, restatements, impacts, etc. And so, based on the above, it's clear that even without factoring in automation versus manual processes, the potential exists that companies can make honest or intentional errors that have cascading impacts. So if you grade companies on how much manual brute force work they do in their contract/order to cash and contract/order to revenue processes versus those companies that automate those processes, the probability of material errors, honest or otherwise, can really be, higher for the former rather than the latter with respect to, brute force and manual versus automation. And so it's an interesting irony that, while the task of financial management is ideally suited to automation, primarily because of the flexibility of tools like Excel that's readily available to, accounting and finance teams, it's extremely frequent that some or all of the processes related to, taking, transactions from their inception through the point in time that cash and revenue is reported, those occur outside of a system. And so this can lead directly to compounded risks and the potential for errors that audits might not catch. The point is that a healthy percentage of CFOs and controllers, they're exposed to such risk, and it's really unnecessary. And because there are solutions available. In SOFTRAX, we provide an option via our revenue manager application to handle and mitigate these risks, because it's replete with controls and full audit history capabilities to prevent, or at a very minimum, substantially reduce the potential of these types of errors occurring. And so I think when we talk about automation, that is a value point that I think companies need to consider as we move forward. So, that's it for today. I think, in conclusion, I would tell you that we will be holding webinars that speak directly to our product's capability, these issues in terms of manual versus automated efforts going forward. And, feel free to reach out to us anytime if you'd like to speak further on our capabilities. We'd really love to hear from you. Also, if you go to our website at SOFTRAX.com or RevenueRecognition.com, there's additional blogs in audio and written form, as well as, other content that would be of interest. Also, please consider registering for our October 23rd webinar, because it will focus on what companies should expect from the SEC regarding 606 for the remainder of 2018 and as we go into 2019. Thanks for taking time to listen. Take care.